For the last 2 years, a single terrifying narrative has haunted the software industry. AI is going to kill the seed-based business model. The logic is simple. If AI agents make humans 30% more efficient, companies will fire 30% of their staff. And since companies like Salesforce charge per seat or per user, their revenue should theoretically collapse. This fear has kept Salesforce stock trading at a deep discount, while the rest of AI sector pumped. But here's a contrarian bet. What if the market is looking at this completely wrong? What if AI doesn't destroy Salesforce's revenue, but actually supercharges it? In this video, I'm going to break down the math behind their new agentic business model, analyze the $9.6 billion Informatic acquisition, and walk you through a discounted cash flow valuation that suggests nearly 30% upside from here. Let's dive in. First, let's look at the machine. Salesforce isn't just a digital Rolodex anymore. It generates over $41 billion in revenue in fiscal year 2026. As you can see from this chart, their business is diversified. The core sales and the service clouds make up about half of the revenue. The real growth engine is hidden in that integration and analytics slice. Here's a pivot. Traditionally, Salesforce sold license. You hire a salesperson, you pay Salesforce $150 a month. But with Agentforce, Salesforce is entering the digital labor market. Instead of charging for a person logging in, they are now charging for the work being done. They are charging roughly $2 per successful conversation handled by an AI agent. Think about the math here. A human support representative might handle 500 tickets a month. That costs a company sales plus the Salesforce license. An AI agent can handle 50,000 tickets a month. Even at a fraction at the cost per ticket, the volume of consumption revenue for Salesforce has no upper ceiling. And this isn't theoretical. In Q3 fiscal 2026, annual recurring revenue for Agentforce and Data Cloud grew 114% year over year to $1.4 billion. This proves enterprises aren't just testing it, they are deploying it. The biggest bear case I hear is, why can't I just build a Salesforce on ChatGPT? The answer is context and data gravity. AI models are commodities. They are generic. What makes an AI useful is knowing your specific customer history, your pricing tiers, your shipping policies. This is metadata. And Salesforce owns the metadata for the majority of the Fortune 500. This is where the $9.6 billion acquisition of Informatic comes in. Informatic is a plumbing that connects old on-premise database to the cloud. By buying them, Salesforce created zero-copy architecture. Zero copy means Salesforce can see and use data sitting in Snowflake or Databricks without having to physically copy it and pay storage fee twice. This reduces friction and makes Salesforce the control tower for enterprise data. If you control the data, you control the AI. That is the moat. Now let's talk about numbers. Salesforce has transformed from a growth at all costs teenager into a disciplined, profitable adult. Look at this margin expansion. In Q3 fiscal 2026, non-GAAP operating margin hit 35.5%. This is huge. They achieved this by laying off overhead in previous years and restructuring their real estate, effectively doing more with less. Management has a target called 50 by financial year 30. That means revenue growth plus margin should be equal 50. They are already close to 45. What do they do with all this cash? They buy their own stock. They have authorized $50 billion in share buybacks. At the current market cap, they can retire nearly 20% of the outstanding share. This puts a massive floor on the stock price. If the stock drops, they buy it back. If it stays flat, they buy it. For an investor, This downside protection is incredibly valuable. Now, let's value the company. Right now, Salesforce stock closed at $189.27 on Friday. Given its estimated 2026 forward earnings per share, $7.38, the stock trades at roughly 16 times forward earnings, maybe the lowest in its history. Our discounted cash flow model assumes a conservative 10% revenue growth rate through 2030 and margin expanding slightly to 38%. Even with these conservative numbers, the intrinsic value comes out to $272 per share. Our official target is $275, which implies a PE re-rating to 24 times. We are essentially betting that the market will stop viewing AI as a threat to Salesforce and start viewing it as a new revenue stream. I want to be clear, this is not a risk-free trade. There are a couple of risks here. The first, AI deflation. If companies fire sales reps faster than they adopt Agentforce, Salesforce loses seat revenue before it gains consumption revenue. That is the air pocket danger. Second risk is integration. The Informatic deal is huge, $9.6 billion. Merging the company with Salesforce cloud culture is difficult. If they fumble this, it distracts management for 2 years. The number 3 risk is macro. We are seeing softness in Europe. If the global economy slows, IT budgets are the first to get cut. Bottom line, Salesforce is an operating system for the enterprise. They own the customer data, they own the workflow. Now with Agentforce, they own the digital workers. At 16 times earnings, you are paying a fair price for a high-quality compounder with a free option on the AI revolution. We rate Salesforce as buy. Watch out for the Q4 earnings print coming up on February 25th. We need to see that Agentforce revenue number keep climbing. Disclaimer, I long Salesforce. This is not investment advice. This is for educational only. Do your own due diligence. Thank you for watching.